everybody, and welcome to the Closing Bell. I'm Kelly Evans at the New York Stock Exchange.
Welcome back. I'm Bill Griffith. The Dow now on track for its highest close of all time. S&P was yesterday. We're going to see whether the stock market can hold on to these gains throughout this next hour and talk about whether there are still buying opportunities at these levels.
And we've got Stephen Roach joining us to discuss that South China Sea ruling and whether China could still be a red flag for investors here. Plus, Roger Altman on whether the UK vote to leave the European Union could pose risks down the road.
Let's get to our, with the market at all-time highs, let's get to our Closing Bell exchange for this Tuesday. Paul Dietrich is with us today, CEO of Fairfax Global Markets. He's at post 9. Along with Stephen Sarge Guilfoyle from Stuart Frankel, and Rick Santelli still looking for buyers of 10-year notes in Chicago. He'll be checking in just a moment here. Yeah, exactly. Sarge, here we are, all-time highs for the Dow and the S&P. Some other averages not the case. What's your assessment of this market right now?
You know, how can you, even though volumes have not really been what you want, how can you not be impressed? They sell oil, they buy stocks. They buy oil, they buy stocks. They sell treasuries, they buy stocks. They buy treasuries, they buy stocks. For several days now, they buy stocks. We're now broken out. We're over above 2150 on the S&P. I guess the next level will be 2161. Beyond that, 2171. You know, I guess you really just can't bet against it. You don't want to be short. If you think the market's going to come in, you want to be buying puts. You don't want to be short equity because that will really get you hurt these days.
You could also get hurt in fixed income these days, Paul. I mean, you know, people are talking about buying bonds here for the capital gains. So what are you advising people when it comes to, you know, maybe they still have some hesitations about getting into the stock market?
Well, you know, you're looking at the 10-year yield at practically nothing, and what we're seeing is people moving out of that and moving into the stock market. And I'm recommending that even with the stock market at historic highs, there are still a lot of bargains in this market. I mean, if you're a value investor, as we are at Fairfax Global Markets, where we look for low PEs, high returns on equity, high free cash flow, there are still a lot of bargains in this market.
Like what?
Well, Apple, for example, I mean, it's selling at a ridiculously priced 10 times earnings, has a 40% return on equity, massive free cash flow. And what people don't understand is that Apple, unlike Google and Facebook that sell services and sell advertising, they sell equipment and they go in cycles. And the reason why the Apple price is so low these days is because of China. Well, you have to understand that buying cycle in China, because in 2012 and 2013, when they first put the iPhone into China, everyone bought it. And most people keep them for 3 or 4 years before they upgrade. We're coming into that cycle in the next year. Goldman Sachs just said that, you know, they think in the next 6 to 9 months, Apple will be selling at $159 a share. Well, that's about more than a 60% increase over what it's selling for today.
Okay.
That's a heck of a good return.
That would be, if you can pull that off there. Hey, Rick, so yesterday, the 3-year note auction, you weren't around, but didn't go well. 10-year note auction today didn't go well. Have we finally discovered that there are buyers that won't go to a certain level, a certain yield below where we were right now? Have we hit a bottom here, do you think?
I just think it's they're debating a better entry point. You know, 7s are considered a lucky number in Las Vegas, but when you haven't had bid to covers, meaning amount of investor dollars chasing amount of dollars available in an auction, when you haven't seen those poor metrics in 7 years for the 3-year or 7 years for today's 10-year, that's not a good thing. When you consider we were at 136 closing yield after trading all day after the good employment report Friday, to see that the auction went off when we were hovering around a 150 yield. Paul said, you know, that's next to nothing. I agree with him until you put it next to a Boone at -10 or next to a JGB, which is -27. Now it's a little bit more something. But I think that investors aren't tiring of the notion that they know they can game the stimulus that doesn't stimulate, or the quantitative easing that doesn't help, or the negative rates that are crazy. They know they can make money. I just think they're debating where they want to get on the roller coaster, and today and maybe tomorrow for the 30-year doesn't satisfy the requirement.
And meanwhile, Sarge, how much of this is, you know, emanating out of Japan? And the focus on former Fed Chair Ben Bernanke going over there earlier this week. Maybe, look at that yen, maybe more stimulus measures coming from the central bank. Is that a big factor behind U.S. stocks?
Well, the story with Japan is that you probably have a fiscal and a stimulus package fused together over there. They're probably going to directly fund the fiscal stimulus package, which may be 150 to 200 billion yen or something like that. And down the road, after they spend this money, don't be surprised if the BOJ forgives the debt. That's how they're going to go ahead and monetize this debt. That's how they're going to expand the monetary base. That's how they're going to explode inflation. And once it succeeds for them, if it does succeed for them, Europe's on deck, Great Britain's on deck, and the Federal Reserve can't be too far behind. And let's not forget the PBOC. This could be how the globe goes about reflating their economies, which could hurt just about everybody else.
So they're not even going to use a $1 trillion coin anymore? They're just going to forgive it outright, huh?
Oh, Rick, something we just didn't mention. How about those indirect bidders? Only 55%.
This is going to be fine ending. Sure, forgive all the debt. Yeah, this is going to be great.
Yeah, you should understand, Rick, that I don't think Sarge is advocating that. I think
not at all. Not one bit.
No, I get what Sarge is doing. Sarge and I are compadres on this issue of insanity in central banking. Yes.
You're on the same side of that $1 trillion coin, that's for sure. So, Paul, you're the value investor. Do you see value in Europe in some of the beaten up stocks there yet?
Yes, there are a whole group of stocks with low PEs, with huge cash flow, and I think now because of Brexit, where there's a lot of people are concerned about the markets, and I think now is a real buying time for a lot of beaten down blue chip stocks in Europe.
Really? Because there's I guess a lot of different places you could look, but would the banks, for example, make your list there?
The thing about Brexit is that it's going to have a lot of political consequences, but in the end, it's going to have zero economic consequences, at least in the short term, because for the next 2 years plus, Britain's going to be in the European Union. Nothing's going to change, and they're going to have a lot of time to renegotiate their trade agreements. And because the markets have been hit with this, now is the time to buy a lot of these beaten down stocks, including financials.
All right, there you are. Gentlemen, good to see you all. Thank you for your thoughts today.
Thank you. Let's move on to Amazon now, falling in the session today after hitting